Okay, let's start. So today we are starting another question, that is Best Baked Bread PLC. Okay, this is also a past paper question, Best Baked Bread PLC. Today we are doing this past paper of, if I tell you from the index of the exam kit, now we are doing a complete exam paper of July 2017. Today we are doing this Best Baked Bread, and tomorrow we'll do Moonbeam Marines. So with that, we will be able to evaluate the complete paper. Okay. So let's start and let's look at what question this question is saying. It's a long question of 62 marks. So
Yep.
let's start. It has some discussion on hedging also. Let's look at it. Assume that it is now July 2007. Best Baked Bread PLC Triple B is a bakery company which makes and distributes bread to UK retailers. Triple B is listed on London Stock Exchange.
Yep.
You work as a senior in the business advisory department of Jenkins, Cragg and Phil, JCF, a firm of ICAEW chartered accountants. Triple B is a client of JCF, but not an audit client. A partner in JCF, Nita Smith, has forwarded to you an email from the Triple B chief executive, Ruth Rydell.
Hmm.
To Nita Smith, JCF partner, Ruth Rydell, Triple B chief executive, 18 July 2007, request for advice. Nita, Triple B's board would like JCF advice on some key issues. I have provided background notes about the company and its industry. Our financial controller has also provided some financial and operating data. Please write a report for the Triple B board responding to the request for advice in respect of each of the three issues below. Our largest customer, Savelo Supermarket, is putting pressure on us to reduce our prices. It also wants Triple B to extend the credit period that it allows. I have provided supporting information and summarized the board request for advice in Exhibit 3. The Triple B board is concerned about the cost and risk of buying wheat. As the
Yep.
director is ill, the financial controller has provided some notes and requests for advice.
So this is where hedging will come in.
Yes, I have concerns about business sustainability, so I'm carrying out some long-term planning. I have provided details, which includes a request for advice.
Hmm.
Partners instructions. Nita Smith gives you the following instructions. Please draft the report requested in the root email addressing the request for advice set out in the additional information she has provided.
So quickly, one thing I just forgot. You never sent me. Can you send me the summary of the hedging stuff?
Yeah, I told you, but I looked into my files. I don't have a compiled one, it's scattered. So I'll compile it over the weekend and I'll send it.
Okay,
Okay.
please. Thank you.
I read the message. If I haven't replied it, this means that it is in mind. Another concern has arisen. I was sent in error an email from the Triple B production director, Jason Argo. This was intended as an internal communication only for the Triple B board members. The other recipients of the email do not appear to have noticed that it was also sent to me in error, and I have not informed them. I have forwarded you this email, Exhibit 6. Please prepare notes setting out any ethical issues arising for Triple B and GCF arising from the matters in the email and from the fact that it was sent to me in error.
Hmm.
Your notes should recommend actions that JCF should now take.
Yep.
Requirement, we have to respond to the instructions from the partner, Nita Smith, and total marks available are 62.
So that's in the email.
Yes. Exhibit 1, background notes prepared by Ruth Rydell. Industry background. The UK retail market for the bread and pastries comprise traditional bread, white, brown, and whole wheat,
Yep.
annually worth $2.3 billion, and specialty bread and pastries annually worth 1.7 billion pounds. In recent years, UK annual demand for traditional bread has decreased slightly in volume terms. Traditional bread prices have been falling as a result of price competition. These are both long-term trends and are expected to continue.
Yeah.
There is increased competition from higher priced specialty bread and from imports. There are low barriers to entry for smaller scale producers, resulting in new entrants.
Mm.
Triple B customers. Triple B sales loaves of traditional bread to supermarkets and other retailers throughout the UK. It sells bread mainly under its own brand, Triple B. However, its largest customer contract is with low-cost supermarket Save Low, which sells Triple B bread under the Save Low brand. Most supermarkets buy bread from a number of different suppliers, but Save Low buys bread exclusively from Triple B. As a result, the Save Low contract is significant to both companies. Triple B charges Save Low lower price for bread than it charges other retailers. Okay, are you listening?
Yeah, yeah.
Triple B's cost and operations. Wheat is the key ingredient for making bread. Triple B buys wheat, which it then grinds to make flour. Wheat is traded commodity, which can vary in price significantly depending on range of factors, including harvest sizes. Triple B bakes bread overnight and normally delivers it to retailers each morning.
Yeah.
Triple B holds minimal inventory of finished good, but it has enough wheat and other ingredients for 1 month's bread production. Triple B has recently increased automation in new specialized machinery, which can make larger quantities of bread of consistent quality.
Yeah.
Triple B's factory is closed on Sundays. Triple B normal operates at full capacity on the floor on 4 of 6 other days of the week. The factory is not normally at full capacity on Tuesdays and Thursdays.
Okay.
Weekly sales are consistent over the year.
Yeah.
Triple B's financial and operating data are prepared by the financial controller. Management accounts, summary statement of P&L for the year. The revenue from Save Low 90,000, other customers 377,600, and total is 467,600. Wheat used in other production.
So Save Low is their one big contract, isn't it?
Yes. So other fixed operating cost and operating profits. Are you getting it?
Yeah.
Yeah. Then they have other operating and financial data.
Yeah.
Number of loaves sold, tons of wheats used, loaves produced per ton of wheat, receivables. So number of loaves sold, 120 million, 472 million to other customers, and then 592 million. Tons of wheat used.
Yeah. Loaves produced per ton of wheat.
Loaves produced per ton of wheat, 2,000 loaves. And these are the receivable balances. At 30th June, Triple B had an overdraft of 12.2 million pounds. The overdraft at 1st October 2007 is forecast to be the same amount. Interest is charged on the overdraft at 8% per annum. The overdraft facility is 23 million pounds.
Yeah.
The Triple B board does not believe that it would be possible to issue new ordinary shares or to raise the loan in the next 2 years.
Yeah.
Production capacity is operating 6 days a week is 610 million loaves per year. Okay. And how many loaves we are producing?
2,000.
No.
2,000 tons, 2,000 loaves per ton of wheat.
Days a week is 610 million loaves per year. and we are
The
just
number
producing
doing 120,
50 million loaves.
592, yeah.
Okay. Operating profit is approximately equal to the operating cash flows for the year ending 30th June. Triple B expects that sales revenue from retailers, other than save low, variable cost per loaf, and annual fixed cost will be same as they were in the year ended 30th June 2007.
Mm.
Exhibit 3, negotiations with Save Low, prepared by Ruth Ryder.
Yeah.
Okay. Now, the Save Low board is demanding that from 1st October, the Triple B board revises the term on which it trades with Save Low. Price competition between supermarkets is fierce. Products such as bread and milk have become key item for retail price comparison surveys between supermarkets. Therefore, Save Low wants to reduce the price it charges its customers by 2 pence per loaf of bread. To compensate for the price reduction, it wants to reduce the price it pays to Triple B by 2 pence per loaf. Also, under the current Save Low contract, the credit period for settlement with Triple B is 30 days after delivery. Save Low is now demanding that credit period should be extended to 90 days for deliveries. The Save Low board has made it clear that its demands are not negotiable.
Not good.
If Triple B does not agree to revise the terms, the contract will be terminated with effect from 30th September 2007.
Mm. Save Low want to extend their credit terms, and they want the price they pay to
Used by
Triple B. They want to reduce the price, the cost there.
The Save Low board has stated that it expects the volume of loaves to sell to increase by 10% as a result of reducing the price to customers. It believes that this volume increase will compensate Triple B for lower price per loaf it will charge to Save Low.
Got it.
Request for advice. The Triple B board needs to decide whether to accept the revised terms demanded by Savelo or to lose the Savelo contract. The board wishes to consider the financial issues and also the operational and strategic issues involved in the decision. The Triple B board would like JCF to provide the following: an analysis and explanation with supporting calculation of the financial impact of the decision to renew the Savelo contract. In
Do we
so,
do do we do a valuation here or something?
yes, evaluation. We have to consider the impact that if we reduce the price by 2 pence, what will be the impact on our profits?
So we basically will do the free cash flows and then present value of that.
Why? Why will you do that?
We're going to do valuation, no?
Why? There is a difference between valuation and evaluation. You will do evaluation, not valuation. Read the requirement. Was it what he's saying?
Okay, so you just want to see the financial impact on the financial statement of the change
I
in.
mean, how they your assets.
Yeah, yeah.
Are they demanding assets? No, they are just demanding they reduce our price by 2 pence. So we need to consider that if we reduce their price by 2 pence, then how it will affect our profits. And if we extend their credit period, then obviously we have to ourselves rely on the overdrafts.
Yeah, yeah.
Okay. In so doing, compare the profit achieved by Triple B in the year 2007 with the expected profit for the year 2008 with new Save Low contract terms.
Yeah.
So I don't think that it is anything which is abnormal.
Okay, sorry, I'm overcomplicating it.
Okay, now. Number two, evaluate with supporting calculations the impact on Triple B's liquidity and cash flows arising from changing credit days from 30 to 90 days. And number third, an explanation of operating and strategic issues arising from a decision to accept the new Save Low contract terms. Because if we accept their new terms, then obviously maybe our existing customers can say that, okay, reduce our price also? Why you are reducing their price only?
Yeah. Also, in terms of credit, in terms of increasing their credit period, then obviously that means that it'll give us maybe cash flow issues.
Yes. Okay. Are you getting it?
Yep.
Now, Exhibit 4, cost and risk of buying wheat prepared by the financial controller. Buying wheat. Triple board is concerned about the risk of wheat price volatility and has started hedging its wheat purchases. The price of wheat can vary from year to year according to factors such as the success of the harvest. Wheat is priced in US dollars on commodity market, and Triple B board is therefore also concerned about foreign currency risk in this respect.
Yeah.
Hedging risk, some choices. The finance director started hedging wheat purchases, but he then needed to take time off work with a long-term illness. I have taken over his role on temporary basis, but I do not understand much about hedging.
Yeah.
The finance director entered into some forward contracts for acquiring wheat as a commodity. An example of these hedge contracts already undertaken are set out below.
Mm.
I am unsure about the financial reporting treatment of hedging strategies using forward contracts. I am also not sure about whether Triple B should use options or forward contracts to hedge and what Triple B hedging strategy should be.
Yeah.
In
So
the
it's similar to yesterday a little bit.
In the finance director absence, I had intended to use options to hedge against wheat price increases. However, since wheat price became more volatile recently, the cost of wheat options has increased significantly. I want to understand why increased wheat price volatility leads to more expensive wheat options, because greater the price is volatile and greater the premium will be.
Yeah.
Are you getting it?
Did you say the greater the price in the real market, the greater obviously?
Greater the volatility is, and greater will be the premium.
Right.
Because when there will be too much volatility, the options will carry a higher premium cost.
So when there's greater price volatility, you're saying in the real world, yeah?
Yes, yes, yes.
Yeah, normal price. When there's greater volatility in the price, then the price of
The premium on the options will,
premium, yeah, the premium option is higher.
option will say that now I have the greater risk, because you'll say exercise labs, so that risk is increasing.
Mm. Yep.
Are you getting it?
Yep.
Okay, now examples of existing hedge contracts undertaken by the finance director. Hedge 1. Triple B has a contractual commitment with the supplier to purchase 5,000 tons of wheat on 15 September 2007 at spot price per ton on that day, denominated in US dollars. Triple B has a contractual commitment with the supplier to purchase 5,000 tons of wheat on 15 September 2007. Okay.
Yep.
To hedge this commitment on 22nd May, the finance director entered into a forward contract at a zero price.
Yep.
This was to purchase 5,000 tons of wheat on 15 September at a price of US $400 per ton of the wheat.
Mm.
At 30th June, a new forward contract could be entered into at zero price for the delivery at $390 per ton of wheat. So this means a $10 loss on forward, because you fixed your price at 400, but now a forward is available at $390.
Yeah, the loss in forward market. Yeah.
Hedge 2. Triple B has a contractual commitment with the supplier to purchase 7,000 tons of wheat at a fixed price of US $420. To hedge commitment, on 4 June, the finance director entered into a forward contract at zero price to purchase US $3 million to purchase
$3 million US dollars.
1.9 million pounds. On 19th October, at 30th June, a new forward contract at zero price for purchase of US $3 million could be entered into 2 million pounds. This means that in this, there is a gap of 0.1 million.
What does that mean though? Like to purchase 3 million for 1.9 million?
Exchange rate hedging, my friend. What's the issue?
That's the hedge. He's entered a hedge to purchase 3 million US dollars worth of tons of wheat for 1.9 million. Yeah.
My friend, this is a hedge of wheat price. This was a hedge for wheat price, and this is a hedge for currency. What is the hedge? Read it here. This was to purchase 5,000 tons of wheat at a price of US $400. This was a hedge for wheat price.
Yeah.
And this was a hedge of
currency.
The finance director entered into a forward exchange contract to purchase $3 million. I didn't say $3 million wheat. I said there was a hedge to purchase $3 million for 1.9 million pounds. We fixed the exchange rate. Okay. Are you getting?
Yeah.
Okay.
Yeah.
Why? Now listen to it very carefully. In this case, we had to turn 5,000 tons of wheat at the spot price. Now, this was the actual contract. Now, this is actual and this is hedge.
Yeah.
Now, here we had to purchase 5,000 tons of wheat at spot price per ton. So we hedged the price of the wheat.
Yeah.
Here we are bound to purchase 7,000 tons at $420.
Yeah.
Here the problem is not of price of wheat, because price of wheat is fixed at $420.
Yeah. Oh, okay. The problem is the currency fluctuation.
Are you getting it? Yes or no?
Yeah, got it.
Okay. So please improve your reading. Read very carefully. I would like GCF to advise and explain whether Triple B should use hedging for wheat purchases. Explain why option prices for wheat have increased over the same period that wheat price have become more volatile.
That's because of the premium goes up because of volatility, yeah?
Yes. Explain for each hedge 1 and hedge 2 the risk of the hedge item. Hedge item.
Yeah.
And evaluate the extent to which these risks have been mitigated by each forward contract. So yes, the finance director has taken the right hedges. In the hedge 1, the risk was wheat price, and in contract 2, the risk was currency.
Yeah.
Are you getting it?
Yeah. So in one, he's taken one of the price changing of the wheat because he didn't fix the price. And in the second one, he fixed the price, but then that price can change with an exchange rate. So there might be exchange rate fluctuations.
Okay.
Yeah, got it.
The appropriate financial reporting treatment in the Triple B financial statement for the year. I don't think there is any issue till now. It's a pretty much straightforward question.
Yeah.
Okay. Do you think this?
It's okay.
Now, Exhibit 5.
I definitely need the pros and cons of each type of hedging though, because it keeps coming up in questions, so you can see. And this is what I said. Remember, I said that the pros and cons of what are the advantages and disadvantages of each option, comparing them to forward, to future, to options.
I'll send over the weekend. Don't worry.
I need that, sir.
So that this reason also ends. Otherwise, you'll say that, oh, my paper didn't went good because you didn't send me that document.
No.
Okay, let's start. Exhibit 5. Long-term planning and business sustainability prepared by Ruth Rydell. Because of expected adverse trends for the bread market, the Triple B board wants to assess Triple B's profitability up to its planning horizon of 30th June 20Y0. This includes making an operating profit forecast for the year ending 30th June 20Y0 based on some working assumptions to test various scenarios. The purpose of this exercise is to determine the long-term viability of the company and to assess Triple B business sustainability if it continues to adopt its current strategy. Working assumption. The financial and operating data for the year 30th June 2008 will be identical to the year 2007. For this purpose, assume that Savelo contract will continue on its current terms for the year ending 30th June 2008. There is a 70% probability that after 2008, the sales volume will decrease at a compound rate of 1% per annum. And 30% probability that it will decrease at a compound rate of 3% per annum for all customers. There is a 60% probability that after 2008, the selling price of loaves will decrease at a compound rate of 2% per annum, and a 40% probability that it will decrease at a compound rate of 4% per annum for all customers.
Yeah, okay.
The cost of wheat per loaf and other variable costs per loaf will remain constant at their levels in the year ended 30th June 2007. Annual fixed operating costs will remain constant at the level in the year ended 30th June 2007. Request for advice. I would like GCF to prepare a forecast of the operating profit or loss for the year ending 30th June 20Y0. Use the above working assumptions.
We just calculate the operating profit again using the assumption.
The expected values. Now, how do you calculate the expected values? Like
you multiply by the probability times the compound rate.
Yes. Okay. So you get a expected value.
And what is business sustainability, sir?
Basically, they are saying that if these forecasts become real, then when business will be sustainable, will it be able to continue in the long term?
Right, okay.
Evaluate the implications of this forecast for the Triple B's business sustainability. Okay?
Yeah.
Now, just a minute. Okay. Explain how your assessment of business sustainability would be reflected in the financial statement and narrative disclosures in Triple B annual report for the reporting periods up to the year ending 30th June 20Y0. Okay. Exhibit 6, emails in error by Jensen Argo to Mita Smith, JCF partner. Savelo has put us in a difficult position by demanding a price reduction. I realize that decision on how to respond has not yet been made, but I think we should consider how we can reduce the cost of supplying bread. This could be a factor in deciding whether to accept its revised terms.
Yeah.
Okay?
Yeah.
These suggestions are confidential and for the attention of Triple B board only. One way we can reduce cost is by using some lower quality wheat in the production runs for Savelo without informing them.
So you just got to talk about here, sorry.
Ethics. We have to talk about ethics in this part.
Yeah, like integrity, obviously, transparency, all that.
Although the contract with Savelo says made using high quality wheat, it does not say that we need to use entirely high quality wheat. Also, the meaning of high quality is vague. For Savelo bread, we can use. We could
mix of high quality and lower quality wheat.
We could continue to use only high quality wheat for other customers. In fact, it is a fact of business that you get what you pay for it. If Savelo pay us less, They cannot be surprised if they get a lower quality product, but we need to make sure that they use lower quality wheat does not change the taste of the bread enough for the consumers to notice it. Okay?
Yeah, well, let's start. Oh,
So let's start solving it.
long question, isn't it? How much how much time per question mark do you get?
Simply 3.5 hours divided by 100 marks.
Divided by 100 marks, you get 2.1 minutes per mark.
Okay, so let's start. I don't think that it is a difficult question. Apparently, things are very good. We have first requirement was to analyze and explain with the supporting calculation of the financial impact of the decision to renew the save law contract. So the requirement of save law is
So we just basically see the how the
how they
forecast changes,
affect our profit.
and that's it. And then okay.
And they have said that the volumes will increase by 10%.
Yeah.
Okay.
And price will decrease by 0.02%. Yeah.
And the liquidity price per difference is the second part, in which they said that assess the liquidity impact also due to the increase in the credit days.
Yeah.
Are you getting it?
Yeah.
Okay.
Do we do creditor days here?
Sorry?
Do we do the ratio for creditor days?
No. You need to consider the impact that if you increase the credit days from 30 to 90 days, how it will affect your overdraft.
But how do we do calculations of that?
Because you have the contract of the save law, that how much tons of loaves you sell.
Yeah.
Then you will be able to calculate that, okay, if we extend their credit is like currently their receivable is 7.5 million, which is for 30 days. If we increase their days, then automatically this receivable will double.
Yeah.
Because from 30 to 90, it's 30 to 60 and then 90. So it will triple. So this will increase your overdraft facility, overdraft impact, which will create the interest expense amount.
Right. Okay.
Okay, let's start doing it so that we can have an idea about the workings. Save law contract. Analysis and supporting calculation for the decision to continue save law contract, June 2008 on operating profits. Okay, so let's refer to the workings. Now, operating profit for 30th June 2007. Now, this is the existing data provided in the question. Their revenue is 90 million for save law and other customers is 377.6.
Yeah.
Now, where is it written?
Just copy that. Yeah, that's fine.
Okay, this is the data which is given in the question. What I is that I've simply pasted it. Okay, now
we've got to put the assumptions in.
So revenue, wheat cost, other variable cost, fixed cost, and the total profit is 33,840. Now, if I work for 30th June 2008, what will happen? Okay. Okay. Now, if I look at the 30th June 2008, now, if I look at the revenue, obviously the revenue from other customers is same. Just a second. Revenue from other customers is same at 377.6 and 377.6. The revenue of save law will be affected. Okay. Now, let's split up the revenue. Let's analyze the revenue.
All right.
Okay. Now, what is save law saying to us? Let's go and read it. Okay. What is save law saying? They are saying that from 1st October 2007, we need revised terms.
Yeah.
From 1st October 2007, we need revised terms.
Yeah.
Basically, this data is still 30th June 2007.
Yeah.
Then in the year ended 30th June 2008, they need revised terms, but how many months will be, some months will be old and some months will be revised.
Yeah.
July, August, and September, 3 months will be old and 9 months will be under revised terms.
Okay, got it.
Are you getting it?
Mm.
Okay. Now, the revenue of Save Low is
90,000.
90 million pounds.
Mm.
Okay. 90 million pounds. How many tons of loaves you sell then?
120.
So what is the price per loaf?
So our revenue was 90 million divided by we sold them 120 million is 0.75.
0.75. They say that reduce it by 2
No,
pence.
yeah, yeah.
Okay.
So it's 0.073 times by 120.
Now, 0.73 multiplied by 120 million, but they say that this 120 million will increase by 10%.
120 million is the number of sold. So we're going to produce, the sales volume has increased by 10%.
Yes. Are you getting it?
Yeah.
But this impact will be on 9 months of the year because 3 months of the year will remain same because the revision will take effect from 1st October 2007.
Okay. Okay. So this has got nothing to do. Okay. So this is just a revision of increased.
Okay.
Yeah.
The revision will be from 1st October 2007.
Mm.
In the year ended 30th June 2008, 3 months will be under old terms and 9 months will be under new terms.
Got it. So we do, okay. So we do 120 million
Okay, let's look at it.
times 0.73 times 110%.
So if I analyze the revenue, some are the existing terms. 120 million is my volume. For 3 months, this will remain same. For 3 months, it will remain same.
So you've just done 120 million volume divided by 12 months times 3 months. Yeah.
Yes. Year end is 30th June 2008. Contract will revise on
1st of October.
will revise on 1st October 2007. Are you getting it?
Yep.
Okay.
So, okay, so the revenue till 30th of September. Yep.
After 30th September means for 9 months of the year, the
Mm.
volume will be this
So you've done 120 divided by 12.
multiplied by 9 months.
Yeah.
And then I have increased it by 10% because the volumes will increase by 10%.
Yep. Got it.
Are you getting it?
Yep. Yeah.
Price will reduce by 2 pence. So this will be my revenue for 9 months.
Yep.
3 months and 9 months, my total revenue from
Oh, for 12 months. Yeah.
Savelo will be 129 million.
Got it. Okay.
You getting it?
Yeah.
So, the revenue from Savelo, revenue, okay, sorry, this is the volume. If I add this revenue, 22.5 plus 72.270, what will be the total? This is the volume. What will be the revenue? Can you tell me?
94,770.
94.77.
770. Yeah.
This will be my revenue from Savelo.
Yeah.
Are you getting it? Hello?
Yeah, I got that. What are you doing about volume for 12 months?
I will talk it about in a while because that will be used for calculating the cost. Okay. So earlier the revenue from Savelo was 90 million, but now the revenue from Savelo is 94.77 million.
Yeah.
Because when we reduce their price by 2 pence,
Yeah.
volume increased by 10%. So if you remember, Savelo said one statement that if we are reducing your price, we are giving you more volume. And that increase in volume will cover your loss of revenue due to the decline in the price. And
Yeah.
it is true.
Yeah.
Are you getting it?
Yeah.
Shall I move forward?
Yeah. Yeah.
Now, the another problem is wheat cost. When I will make 10% more loaves for them, that will affect my wheat cost also.
Yeah.
Okay, now wheat volume of wheat converted from 120 million loaves to revised volume of 129 million.
Mm.
Earlier, you used to make volume of 120 million loaves,
Yeah.
and now your volume for them will be one.
Oh, because you've added up the two volumes, yeah? Well, you've added up 99 plus 30,000.
Are you getting it?
Yeah. Yeah.
What was the wheat cost? Now, if you look at it here, your wheat cost earlier,
Mm.
um, my wheat cost was earlier. How much? If I
15 pounds.
did just a minute here, it is written in the question. Now, my wheat used in production was 15,600.
Mm.
Okay. Now, this was my wheat cost used in production was 15,600. But now, my wheat cost used in production will increase because I will
Yeah.
make greater loaves. This wheat
Yeah.
cost was for 120 million loaves, and now I will make 129 million loaves.
So how do you work this out now?
And tons of wheat used were 60,000. Obviously, the tons of wheat used will also increase.
Mm.
Are you getting it?
Yeah. So how do we work this out?
Just a second. Now, 15,600 divided by 120 million multiplied by 129 million. What will it give?
So you're saying the wheat cost 420 million.
So this gives you 16,770 million.
Yeah.
Okay?
So that's the wheat cost for 129,000 million volume, yeah?
Yes. Are you getting it?
Yeah.
Okay. Now, basically here I have broken it down. Here I have volume of wheat multiplied by wheat cost per ton. Here I have done a more detailed analysis, but you can get the 16,770 directly also.
Yeah, don't do the complex stuff, just do it simple.
Why did I do the complex working? Because I will talk about the utilization rate and my capacity things also later
Mm.
in my commentary.
Yeah.
It is your choice. You can do it directly also. I have shown it directly also.
Yeah, it's better.
Okay. Like for example, what I have done below is that your volume, tons of wheat used was 60,000.
Mm.
Tons of wheat used was 60,000, and your wheat cost used in production was 15,600. So what I have done is like 15.6 million
Mm.
divided by 60 million tons of wheat used.
Mm.
You will get the wheat cost per ton.
Yeah.
Not 60 million, this is 60,000. So you will get the wheat cost per ton.
Yeah.
Are you getting it?
Yeah,
No.
yeah. And then we multiply that by what? The number of tons.
60,000. So this gives you 260 per ton.
Yeah.
Then you can, what you can do is that you can increase your tons of wheat by 110% for 9 months.
As in that's £260 per cost. That's the cost per ton.
Yes. 120 million was your existing tons, and revised tons are 129 million of loaves,
Mm.
129 million loaves. So 60,000 divided by 120 into 129. So this means that you will use 64,500 loaves, tons of wheat.
And then you multiply that by 260.
So you will get the same amount, which is 1677, which you have calculated it directly here.
Ah, got it.
Okay.
Yeah.
Other variable cost, what you have done is that you simply wrote down 48,000, okay, 15,600 divided by 120 multiplied by 129.
So here you do 48,000 divided by 120 times 129. 51,600, yeah.
48,000 divided by,
120 times 129.
are you getting it?
Yep.
Fixed cost will remain same. And if you now look at your operating profits, they stand at same level.
Yep.
Are you getting it?
Yep.
Okay.
Yep.
Now, let's move forward.
How do they stand at the same level?
Because when our selling prices it reduced, but our volumes increased by 10%.
Mm.
Okay.
Yeah, but surely everything's gone up on Save Low. Then how comes the total is not more?
Your revenue has increased, but your cost has also increased.
Yeah, of course.
You
Yeah.
can calculate it.
No, I did. That's fine. Yeah.
Okay. Now, are you getting it till now?
Yeah. Got it.
The first question he asked from you. An analysis and explanation with supporting calculation of the financial impact of the decision to renew the Save Low contract.
Yeah.
So, yes, our total profits are at same level.
Yeah.
But what you need to understand is that the approach of Save Low is not the right approach. Because you have to give the discount to customer, you reduce the price of the vendor.
Yeah.
They should have a better approach. That they should have said that, okay, we are increasing the volume, we are going for more business, so we have to give a 2 pence discount to customers. So okay, triple B should take impact of 1 pence, and 1 pence impact will be taken by us. But what they are trying to do is that they are simply trying to exploit us.
Yeah.
Okay? And doing the business with Save Low is not enhancing our brand image,
Yeah.
because they sell our bread under their own brand name.
Okay. So they're not promoting our brand.
Okay, are you getting it?
Yeah.
Okay, and plus selling at such a low price, will use up our capacity.
Selling our bread at such a low price will
Will
bring competition.
Now, if you remember, our production capacity was 610 million, and we are currently producing at 592 million tons. So
Yeah.
if we sell more to Save Low at a low price, our volume, our production capacity is getting abused, and as a result, we may not be able to get more profitable contracts.
Oh, because we're having to produce more, selling less to get the same amount of revenue from Save Low. We're having to produce more to sell the same amount.
Yes.
And therefore our production is going higher, and therefore we can't use up capacity for other contracts.
To other customers, my revenue is 377,600 million. And I have sold to them 472 million tons.
Yeah.
So just compare my price. What is the price I'm giving to other customers?
Total revenue is 377,600 divided by 472 million.
So my cost, my price is 0.789, almost 0.80.
Yeah.
Already selling to Save at almost 5 pence below price, and now they say that okay, reduce the price by 2 pence further. So if we
Not profitable.
if we use up our production capacity against Save Low, then what will happen is that we will not be able to take more profitable contracts of other customers.
Got it.
Are you getting it? Okay, now, like for example, here, if I increase my 120 million to 129 million,
Yeah.
so 129 plus 472. So this will give me a total
601.
601.
That's that capacity, isn't it?
Listen it very carefully, in 2008. But in a normal year, this will be This will be 132 plus 472. Why? Because in 2008, 3 months were based on old volumes.
Oh, yeah.
This will give me 604.
Yeah.
My capacity is 610, so I will be almost.
Yep. You got a good point.
I
Let go.
or not.
I get it.
Okay, so 592 divided by 610. Currently, I'm operating at 97%.
Yeah.
2001, I will be at, in 2008, I will be at 98.5%. And then I will be at 99%.
Yep.
Are you getting it?
Yep.
Okay, so let's look at it. If operating profit is analyzed and claim of save low is correct, that triple B will remain equal due to price reduction as its impact will be adjusted against the volume increase. Are you getting it?
Yep.
It is based on assumption that change in price and increased volume will become applicable from 1st October 20x7.
Yep.
However, it can be argued that constant operating profit is not worth justifying in agreeing terms of save low as reduction in price is absolute,
Yep.
whereas increase in volume is not a certain change. Do you understand what I'm saying? They say that reduce our price by 2% and the volumes may increase by 10%.
Oh, okay. So it's not obviously guaranteed that our volume is going to increase.
It is not necessary that volumes will increase as Sablo has not given any such guarantee. But the reduction price is guaranteed that we have to sell them at a lower price.
Got it.
The claiming that volumes will increase immediately is not necessary as it will take time for customers in responding to reduction in price.
Got it.
Further, due to increased volume from Save Low, Triple B will have to operate near its total capacity, and as a result, it will not be able to accept any short-term lucrative deals from other customers.
Got it.
Other customers generate greater contribution as compared to Save Low, as their price per loaf is 0.8, whereas Save Low price is 0.73 as per the revised terms.
Yeah.
Are you getting it?
Yeah. Yeah, I'm getting it, kind of, yeah.
Why kind of? What's the problem?
When you say generate a greater contribution as compared to Saver,
And the selling price will be higher, it will generate more contribution. Contribution means selling price minus the variable cost.
oh yeah.
You can write greater profits also.
Yep.
Okay, are you getting it?
You just done that price per loaf. Yeah, got it.
Okay. Now, the part B was evaluate the liquidity and impact of increase in debtor days.
Yeah, this is what I want to know, how you work this out. Because how can you bloody work this out?
Increased from 30 days to 90 days. Then receivable balance of Save Low, which normally ranges around 7.5 million, will rise 3 times higher and will become around 22.5 million.
Right.
Why or right?
Right. Right.
This will increase the interest cost of Triple B as it is operating on overdraft.
Oh, okay. So this is my question. So why? Okay, so interest. Okay, because if our receivables are if our revenue's taking longer to get paid, then we're gonna.
Your current receivable is 7.5. It will increase by 3 times because they are asking to increase days from 30 days to 90 days.
And so therefore, then we're having to use our loan, our overdraft.
Okay. Now, current overdraft remains at level of 12.2. And it will rise to 20.8 million if 90-day cycle is allowed.
How?
How? Let's look at it. Now, refer working, we look at the working. This means that additional overdraft, 8.6 million, interest cost will be 0.69 million. So let's look at the working. Now, evaluation of debtor days. Existing debtor days. Savelo pays in 30 days. Savelo pays in
30 days, yeah.
And other customers pays in 45 days.
Yeah.
How did we get this 45 days? Now, if you look at it here, the receivable from Savelo is 7,500 and from other customers it is 47,000. So if you calculate your receivable days,
Okay. So how is receivable days again?
receivable days, receivable over sales multiplied by 365.
Yeah.
Okay, so in Savelo it is 30 days. Whereas here 377, here the receivable is 47,000 divided by 377,600 multiplied by 365. So here it's 45 days.
Yeah.
Okay. Now if I increase this 30 to 90 days, so obviously my rolling receivable will increase.
So then basically we just rearrange the formula.
Now the problem is that Savelo, listen it very carefully, the Savelo sales are also, the sales amount is also expected to increase by some amount, if you remember the forecast.
Yeah.
Okay, so let's look at it. Now, cash cycle starting from October, 90 days, as Savelo will take 90 days rolling cycle. Now, opening overdraft given in the question was 12,200. Okay. Now, other customers we receive in 45 days.
Yeah.
Okay. Assuming that 47 million due will be received in mid-October, and then this receivable will again get received 1.5 months later in November, receivable balance will be constant. Now, what do you mean by this? Now, this means that if you have a 47 million receivable of 45 days, okay, so after every 45 days, you'll be receiving 47 million, 47 million, 47 million. Okay, so for example, if your receivable was created in August, then in September and October 15th, you will receive 47 million.
Yeah.
And if you receive on October 15th, then next receipt will be at the end of the November.
Yeah.
Listen it very carefully. The next receipt will be
end of November.
Because October 15th, then November 30th, then January 15th. This is the 5 days rolling cycle.
Okay.
I'm repeating it again. What is other customers' 45 days rolling cycle? Like if I got a receipt on October 15th, then next will be on November 13th, then next will be on January 15th. This will be the rolling cycle.
Yeah.
Are you getting it? Now you can assume other rolling cycle also. Like you can say that, okay, if I assume that 47 million will be received on 1st October, then receipt will be on October and November 15th.
Yeah.
And next receipt will be on 31st of December. You can assume that rolling cycle also.
Right, okay.
Okay. Now, see, I have used the word assuming that million due will be received in mid-October. Like I said that, okay, if I assume that this 47 million will be received in mid-October and it was due 1.5 months ago, then mid-October, after mid-October, next receipt will be on 30th of November, 45 days rolling cycle.
Yeah.
Okay.
Okay.
Now, you have to pay expenses every month.
What are we trying to work out here? Receivable days.
I'm trying to calculate that what will be the impact on my cash flow if I accept the new terms of the Savelo.
Okay, right.
Now, usually the Save Law used to pay 7.5, 7.5 every month because they were on 30 days. But now if we accept their terms, we will get after every 90 days.
Oh, okay. So you're basically, So you're basically just showing how, in terms of how quickly we get our payments, receivables, then obviously it'll affect how much money we have.
But now we will get 7,500 in October, then the 7,500 will be in January. 7,500 because after 90 days we'll get our amount.
Yeah, got it.
Are you getting it?
Yeah.
And if you change your terms from 1st of October, then in November, December, you will not get anything.
Right.
Okay?
Yeah.
So if your overdraft is 12.2 million negative in the month of October, he said that, okay, our overdraft, gave us the overdraft balance in the question that at 30th June 2007, Triple B has an overdraft of 12.2 million. The overdraft at 1st October 2007, because 1st October 2007 is the date from which we are changing the terms with Save Law.
Yeah.
Okay.
How do you know what the overdraft then is? 12.2 again.
At 1st October 2007 is forecast to be the same amount.
So it's 12.2 again.
Okay. So if I keep it at 12.2 million, then in the month of October, if I assume that I'll receive my 47 million from my those other customers and 7,500 from Save Law as the old 7,500, because the change of terms will be implemented on the new receivables.
Yeah.
So my receivable balance will be 5.7 million in the month of November. But in the month of November, 5.7 million.
Yeah.
47 million from other customers.
Yeah.
No 7,500. So
Yeah.
it will be at 16.2 million overdraft.
My question is, how in November, how have you got the opening overdraft of 5.756?
This from here. I just shifted the balance above.
Which balance above? Oh, okay.
This is the rolling cycle.
Okay.
Rolling cycle. Then if you put 16.2 million here, so obviously
Right.
47 on 15th October, 47 on November 30th, then next 47 will be on January 15th.
Right. Okay, so this is, you're showing about the liquidity here, yeah?
Yes, but this is entirely based on the assumption-based working. A student can have different assumptions also. Are you getting it?
Yeah.
So in this working, what I'm saying is that by the end of the December, I will be at 20.3 million overdraft.
Yeah.
Okay. Now my existing overdraft was 12.2 million, which will increase to 20.3 million.
Yeah.
I think it was 20.3. It's 20.3 by mistake. I've written 20.8.
Yeah, that's fine.
20.3 million.
Yeah, that's fine.
I have shown an impact that this will affect my interest expense. Or some students can do this also, that they'll say that, okay, 7.5 million into 3 times. They'll say that now I'll stand at 22.5 million. Earlier my receivable was 7.5. So 7.5 minus 22.5. They can also say that, okay, my receivables will increase by 15 million. So they can also show the working on 15. Now, this is the depth of the working every student will do on their own understanding, on their own ability to analyze.
Yeah.
Are you getting?
So you're saying normally for 30 days, receivable is 7.5. It's going to rise to 90 days. So we just triple that receivable to 22.5. Yeah.
Okay.
Yeah. Okay, Con. Let's go.
Okay.
Yeah.
Further giving credit period will increase the exposure of Triple B, as greater amount will be stuck with Save Law, which is involved in intense competition. So there may be risk of bad debt and things like that. But very important thing, further an issue is questionable that Savelo deals in retail business.
Yeah, which needs cash.
No, no, no. What you need to understand is that the customers to whom Savelo send its good, pay them in cash.
Hmm.
So why do they want credit from us?
Oh, why do they need such long time payment days?
What are they doing of that money? Maybe they are using our funds, and if they are using our funds in some risky activity, then it's a problem.
Oh, you're basically saying our customers pay us in cash.
The Savelo customers pay them in cash. What do Savelo do? Savelo is a supermarket. In
Yeah.
supermarket, do you pay in credit?
Oh, okay. So Sablo gets obviously, so it must have a lot of cash. So why is it taking so long to pay us?
Yes, yes, yes. Are you getting it?
Yep.
And the third comment was the overall strategic and operational comment that if we accept the Savelo demands, then what will happen? Are you getting it?
Yep.
Now, you need to understand is that Savelo is your competitor also.
Yeah.
Be sells its brand under its own brand name in other supermarkets. But what Savelo do is that Savelo simply brand our brand in its own name and then it sells itself under its own brand name.
Yeah.
Now, if I will start selling my bread to Savelo at a very low price, then I'm automatically killing my own brand
Yeah.
because the customer is getting the same thing under the Savelo brand at a lesser price.
Yeah.
What the strategy should be is that we should be selling our branded product at a lower price and we should be charging a higher price from Savelo because it do not becomes our direct competitor.
Yeah. Yeah.
Are you getting it?
Yeah.
Then obviously the other retailers will also get annoyed that why do you sell at Savelo at very low price? Because if the Savelo will reduce its prices by 2 pence, automatically there will be a competition created in the market and other retailers will also demand us to reduce the price.
So you're saying basically just sell it directly to the market, to the customer for a cheaper price, offer a discount there rather than offering discount to our competitor who then sells it on cheaper anyway. So in effect, if we're doing that way, we're letting our competitor Savelo gain more of the market share by selling the bread.
In our own brand.
Yeah, when it's our bread. So we're losing market share off our own bread.
Now, second thing is that if the Savelo will give the discount in the market, now it was written in the question that there is intense competition in the market.
Hmm.
Whenever there is a perfect competition in the market and one competitor reduces the prices, the overall price of the market will take a fall.
Yeah.
So when the overall price of the market will fall, then automatically the other retailers will demand from us that reduce our prices also because their breads will not be able to be sold.
Got it.
Are you getting it?
Yeah. Yeah. Got it.
So if Triple B reduces the price for Savelo, then Savelo will reduce the price per loaf for its final consumer.
As a result.
As a result of which other supermarkets will also reduce their prices for final consumer.
Hmm.
This will lead to pressure from other supermarkets also on Triple B to reduce the price per loaf.
Yeah.
This means that existing customers of Triple B will also reduce the price as Triple B is enabling Savelo to start the price war.
Yeah.
Are you getting it?
Yeah.
Further, if other customers get knowledge that Triple B is quoting low price of 0.73 to Savelo, whereas a higher price is quoted to them of 0.8, they may also require a reduction.
Yeah.
However, it can be argued that if Triple B denies to Savelo for reduction in price, then it has to lose the customer, which is generating a positive contribution for it.
Yeah.
Savelo generates a positive contribution of 26.4 million on a yearly basis.
And so positive contribution is basically just revenue minus variable costs.
And you are provided with the revenue and the wheat cost and the variable cost. So you can easily calculate the contribution. I don't think that it is a difficult thing. Therefore, losing contract might not be a viable option.
Hmm.
However, agreeing all terms of Savelo will show that Triple B is in weak negotiation position, and Savelo may continue such threatening terms in future also.
Yeah, they might ask for a discount further.
This is for final consumer is in issue of Savlo, which is a retailer, and not an issue of Triple B, who is a manufacturer. What they are saying is that if we are taking a hit of 2 pence from the consumer, you should also take the 2 pence hit. Why will I be take the hit of 2 pence?
Yeah.
Consumption of traditional bread is getting reduced as per data provided, and Triple B primary product is conventional bread.
Mm.
Therefore, Triple B needs to evaluate that only positive factor offered by Savlo is that volumes will rise is a possible option or not.
Yeah. So see if that's actually how realistic that is.
It needs to be considered that bread manufacturing market is a market with low barriers to entry. Therefore, if Triple B will not agree with the terms of Savlo, they may find someone who will agree on their terms, as there will be several producers, and it can be observed that on a price of 0.73 also, the contribution is positive.
Mm.
Are you getting it?
Yeah. What do you mean about all this? As there will be several, and it can be observed that on
So,
price of
in the
70.
question that there are several bread producers in the market.
Yeah.
So if you will not produce the bread at the demands of the Savlo, they will go to some other producer.
Mm.
And as it is generating the positive contribution, this means that the things are viable for other small producers who may accept the demands of Savlo.
Yeah.
Are you getting it?
Yeah. Yeah.
Okay.
Yeah.
So let's talk about hedging. The first question is that advise and explain whether hedging should be done for wheat. Um, he asked three heads here that whether we should hedge the wheat prices.
You're basically going to go and say that obviously you're going to show how wheat represents a big percentage of total costs. So therefore, wheat is a very important factor. So therefore, you want to control it. So therefore, you should hedge.
In wheat price, there are two factors. That one is the exchange rate exposure, and then other is the wheat price exposure.
Yeah, yeah, yeah.
And most importantly, we have to fix the price with the customer. When our customer price is fixed, we cannot carry forward the impact of the volatility on the customer.
Mm.
Do you get
Yeah.
it?
Yeah. So if you're saying basically if our wheat is high, the cost, we can't then charge our customer more money
And we have
because the price is fixed.
Okay, so when the customer, now if you remember that Phantom West Airline, in Phantom West Airline, this was not the situation, the previous question. In Phantom West Airline, we can put the pressure to the consumer, like we can increase the price of the consumer. But here we cannot do so because we have the fixed prices like with the Save Low. So when we have a fixed price with the consumer, so we have to minimize our maximum possible risk.
Got it. So it's more, if anything, it's more important to make sure you hedge for the price,
Okay.
the cost of wheat.
And he asked that explain why options for wheat have increased over why the price of the options for wheat. So I think that it's pretty much simple that as there is more volatility, so more premium is being asked.
Can I read the answer and then I'll.
I think there is nothing that you need me to review it, but I'll just read the overview elements. Okay.
Yeah, yeah.
Like if I go and just read out the overview elements, that wheat cost represent 18% of the cost of Triple B, and wheat prices are volatile. Considering this, it represents high cost and volatility. Triple B should hedge, otherwise a small change in price will have greater impact. Okay?
Yeah.
There are two types of exposure. One is harvest risk and other is exchange rate risk.
So your harvest risk, you're basically saying the price of the wheat,
Okay.
and secondly is the exchange rate.
Can you hear me?
No, sometimes you cut out.
Yeah, can you hear me now?
Now I can, yeah.
Okay. Now, wheat is, if harvest is not good, then the price of the wheat becomes volatile.
Mm.
Okay. And other is the exchange rate exposure. So obviously we need to hedge it. And it can also be argued that our primary business is to sell loads. Our primary business is not to play with the price of the wheat. If we will get involved in playing with the price of the wheat, our focus will get diverted and we'll not be able to focus on our primary business.
Yeah, yeah.
Okay. However, it can be argued that if price of wheat moves favorably, then companies which have taken the forward contract will not be able to gain benefit of that. Okay.
Got it.
Then the question is that why higher premium is being demanded. So obviously when there is higher volatility, then obviously the writer of the option, the person who is offering you the option, will have a greater risk and he will demand a higher premium.
Would you say that there's also a higher premium with option because of the fact that you can exercise all laps?
Yes, yes, yes.
You can say that, yeah?
Yeah, because the person who is writing the option has an obligation. You have the option.
Hmm.
So
But that's why I have to pay a higher premium, because of the fact that I have that option. Whereas in forwards and futures, you don't do.
yes, yes. Okay. Are you getting it?
Yeah. What does it say here? PBB has to purchase wheat, therefore its risk is the price of wheat will rise, therefore it has to trade in call options, right to buy at today's price.
Triple B has to purchase wheat. So if you have to purchase something, you will use the call options.
Oh yeah, because if we're buying in American dollar, we're gonna have to. The call is the right to buy. Yeah, yeah.
As if the prices will rise, it will earn in those option contracts.
Hmm.
If prices of wheat are volatile, then writer may not be willing to fix the price near to the spot rate. He may provide options at a price which is at margin to spot along with a premium which covers his possible loss if market price rises above the exercise price.
Yeah.
Because obviously the writer of the option also wants to protect himself. So he will take a higher premium and he'll fix a higher exercise price.
Mm.
Are you getting it?
This bit I don't get, which covers his possible loss if more.
Like for example, if the wheat is going at $400 in spot,
Yeah.
and high volatility expected in the market. So will you offer me the option at $400? You'll say no. There is high volatility in market. I'll offer you at $500. So I said that why are you charging such a difference of $100? So you'll say that it saves me from the exposure because you are the writer of the option. You want to protect.
Oh, so you're saying that obviously you're if the normal price of 400 rises above 500, then obviously there'll be a gain in the forward, but a loss in the future.
Think about the writer of the option. The person who is offering you the option contract will suffer a loss.
Yeah.
So he is charging more to protect himself because there is volatility expected in the market. But when there is no volatility in the market and it is expected that price will take a very small change, so you will keep a lesser margin.
Got it. Yeah.
Okay. And then we have to comment on the effectiveness of the hedge, that in hedge one, we hedged the price of the wheat. And in hedge two, we hedged the exchange rate.
Yeah.
Do you remember?
Yeah, I remember the two. Yeah, price and exchange rate. Yeah.
We has taken to hedge to fix the wheat price at $400 per ton. Triple B had to purchase 5,000 tons on spot rate of 15 September. Triple B was facing a risk of change in wheat price, therefore, old finance director to.
Yeah. You know when it keeps saying spot rate, is spot rate the actual price or the price of the option?
Spot is the actual price, my friend. You have studied hedging and now you're asking that what the spot price is.
Okay.
Spot price is the price, the actual market.
Actual price, yeah. That's it.
Now we have to purchase the wheat on the spot price of 15 September, which is in the future. So we are worried that the price of the wheat will change. So we have taken the hedge to fix the wheat price.
So we fixed the price at 400 per ton.
$400 per ton. However, he failed to hedge the exchange risk as Triple B has to pay to the supplier in dollar. And forward is also in dollar. Triple B local currency is pound. If currency depreciates, then Triple B has to pay extra amount to supplier. And these forward contracts will not be effective to mitigate that risk.
One sec. So what's this again? So we have to pay in dollars and our local currency is pound. So therefore, that means that it's
and you will face a greater cost.
I didn't hear you. So what did you say?
If there is currency depreciation, then you will face a greater cost because you have to pay.
What was it? Is this the whole indirect direct thing again?
Why are you getting? You simply think if there is no conversion issues and that things given in the question, you simply think that the things are in direct quote. If your currency will depreciate, you have to pay more. You have to send more pounds to carry the dollars.
Oh yeah. If our currency depreciates, yeah, then we have to pay more.
Okay.
And if our currency depreciates and we're receiving a payment,
Then we will face a loss. It's very simple. If your currency will depreciate and you have to pay, you have to send more boys of yours to carry.
yeah.
So that will create a cost because your boys are getting weaker if the currency is getting depreciated.
Are you assuming it's a direct quote or indirect quote? Because it changes, obviously.
Always think on direct quote when the things are silent. Because
Okay, so that's what I'm saying. So if it's direct quote, then it's multiplying.
yes,
Yeah. So obviously, if you're paying, then you have to pay more. If you're receiving,
and
then
appreciated, then you will receive less.
then you'll receive
Because
less.
lesser amount from the other person.
Yeah. No, but how do you receive less? Because you're multiplying.
Yes, but think about it. Like for example, if I have to receive, if I have to pay $100 to you,
Yeah.
I have to pay $100 to you, and my currency gets depreciated, then I have to incur greater cost in rupees to pay you.
Okay.
Okay. Now, if the currency gets depreciated, then in case of payment, you have to bear a greater cost.
So when you say currency, you're talking about pound here.
For you, it's pound, but for me, it's rupee.
Okay.
In this case, we are talking about pound because triple B, the local currency is pound.
Hmm.
Okay. Now, in hedge one, listen it very carefully. In hedge one, he hedged the risk of the wheat price, but he failed to hedge the risk of the currency.
He sorry, what?
In hedge one, he hedged the risk of the wheat price because he fixed the wheat price in dollars
Yeah.
through the hedge, but he didn't hedge the risk of currency.
Yeah.
Are you getting it?
Yep.
In hedge one, he fixed the price through forward at $400, but he didn't hedge that what will happen to the currency exposure.
Yeah.
Are you getting it?
Yep.
If effectiveness of hedge is evaluated, then it can be argued that entering in hedge contract was not favorable as wheat price has reduced to $390 per ton. This means that in spot market, Triple B has to pay $10 less, but in forward market, however, this benefit will be wasted against the loss on the forward market.
So we made a loss in the forward, but we've made a gain in real.
Yes, because we fixed $400 in the forward, and the actual price is now $390. So in actual market, we'll pay less, but due to forward, we have to face a loss of $10. So now we are stuck on the forward price.
Yeah.
Okay, but hedge one didn't cover the foreign currency exposure.
Yeah.
Hedge two, if second hedge is evaluated, then it can be observed that second transaction has no risk of commodity price as price of wheat is fixed at $420.
Mm.
In second transaction, the price of the wheat was fixed.
Yeah.
And the finance director took a hedge of foreign currency.
Yeah.
Do you remember or not?
I thought the first one we fixed the price.
In first one, we fixed the price through forward.
Yeah.
Triple B has a contractual commitment with the supplier to purchase 5,000 tons of wheat on 15 September at spot price denominated in US dollars. Now, in the actual contract, do you have a fixed wheat price?
No.
No. Okay. So what did he use? To hedge this commitment, the finance director entered into a forward contract. This was to purchase 5,000 tons at US $400. So through hedge, he fixed the price of the wheat.
Okay. Whereas in the second one.
Please. But he missed the foreign currency exposure in hedge one.
Yeah.
Because the forward is also in dollar.
Yeah.
In hedge two, the actual is Triple B has a commitment to purchase 7,000 tons at $420.
Hmm.
In transaction two, we don't have an exposure of wheat price.
Yeah.
In transaction two, we don't have a
Exposure of wheat, the price.
wheat price. So what did he do? He fixed the currency in transaction 2.
Right. Okay.
Are you getting it or not?
Yeah, I'm getting it.
Okay. So 7,000 tons into $420. What was our actual payment?
So
It was 2.94 million.
2.94, yeah.
Sorry, $2.94 million. Okay.
Hmm.
And he has fixed that he will take $3 million for 1.9 million pounds.
Yeah.
Okay. The finance director took forward to hedge the foreign currency risk by forward contracts to purchase $3 million for 1.9 million pounds. Cost of wheat purchase fixed in dollar was $2.94 million.
Yeah.
This deal of finance director proved to be beneficial as pound has depreciated and cost of $3 million has increased to 2 million pounds. This
Right. Okay.
is
So obviously, so
million.
we're saying we have to pay more. We have to pay more now, so our pound has depreciated.
But in forward market, we have gained because we fixed it at 2.9 million pounds.
Got it.
Are you getting it?
Yeah. Yeah. Got it.
As far as financial reporting treatment is concerned, both of them are cash flow hedges.
Yeah. Yeah. We did this
Because
yesterday.
both of them are for future transactions.
Yeah.
Okay, so both of them are cash flow hedges because in both of them we are fixing the future purchase transaction. So we will park the gain or loss in the OCI.
Mm.
Are you getting it?
Yeah.
And then the actual inventory will come, then we will transfer it to the P&L.
Yeah. Yeah. Yeah.
Okay, you think you will be able to do it?
Let me just quickly. Can I quickly go over the calculation bit with you? I understand the rest. I understand. So you're saying the forward contract in hedge one was fixed at 400 late. Okay, so 400 times 5,000 tons. Later at year end price of forward con declined to 390. So we had a loss
Also,
in the forward.
because we fixed at $2 million, but now it stands at $1.95 million.
Yeah, so we suffered loss 50,000 in. So this loss will go in OCI.
Okay. Now the question is that what about the foreign exchange exposure?
Mm.
What about, because I will book this loss in my accounts in pounds, I cannot book it in dollars.
Yeah.
It was stated in the question that $3 million were 2 million pounds at the year end.
Yeah, so that's okay. So one, yeah.
Two, it was written.
Mm.
So the loss of $50,000 in pounds will be 33,333 pounds.
So that's it. Foreign over local. So that's indirect. So do 50,000 divided by 1.5. Yeah. Okay. Got it. Yep. That loss will go to, yeah. Okay. OCI.
And in hedge two, it is fair enough. We fixed $3 million at 1.9 million pounds.
Yeah.
The year end, it is $3 million to 2 million pounds. So there is a gain of 0.1 million. This will be again parked in OCI till the actual wheat purchase is executed.
Got it.
Are you getting it?
Yeah. 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 Got it.
Because both of them are for future transaction. So both,
Yeah, I know. I get that. I get that. It's perfect. I got it.
okay.
Yeah. Anything else now?
Yes, 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 yes. Still two parts are remaining in the question.
What?
Now, the long-term planning, the assumptions, he said that this will happen, the sales will increase. Do you remember the probability, the 70% probability that
So you just need. So you
what
just need to do.
decrease by 1% and 30% probability that volumes will decrease by 3%.
Yeah. 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 Okay. Let's do that.
So we have to prepare a forecast of the operating profit, use the above working assumptions, evaluate the implications for the sustainability of the business,
Yeah.
and explain how your assessment of business sustainability would be reflected in financial statement.
Okay.
So if I work out these assumptions, now, operating profit for the year ended 20Y0.
Okay.
Now, revenue is 467.6. In 2008, it will still be same because he said that assume that save low contract will be at same levels.
Yeah.
So now what I'm doing is revenue, probability, sales volume. One probability is 70%. If you remember, what are the probabilities? Hello? I think there is some connectivity issue. Let's resume again. Now, the sales
What do we do here?
probability, there are two probabilities of sales volume, 70% and 30%. Do you remember? There are two probabilities of sales volume. If I show you here, 70% probability that sales volume will decline by 1%, and 30% probability that sales volume will decline by 3%. Then
Okay, got it.
percent probability that selling price will reduce by 2%, and 40% probability that selling price will reduce by 4%.
Got it.
Okay. So what I'm doing is that simply creating the possibility cases. There are two cases of sales volume and there are two cases of selling price. So I have multiplied each case with each case.
Yeah.
By this, 70% chance that volume will be 99%.
Yeah.
70% chance that volume will be 99% means it will take a 1% fall.
Yeah.
Okay. And 60% chance that price will be 98%.
Okay.
Because in one case, he said that volume will decline by 1 and price will decline by 2.
Yeah.
Then this is 70-60. Now this is 70 and 40. 70% chance that volume will be 99% and price will be 96%.
Yeah.
You are not getting it.
Okay, no, I'm getting it. You're doing the but then what about the compound probability?
I will do the compounding impact through the power. What do I mean by power? Power means that I will put the impact of 2 years.
Yeah.
Okay. Then 70-40, then 30-60, and 30-40. Now what I'm doing is that he said that in volume there are two cases, 70 and 30.
Yeah. In price there are two
cases, 60 and 40.
Yeah.
So what I did was I did 70 into 60 and
17 to 40
into 40.
And you do 13 to 60, 13 to 40. Okay, got it.
Into 60.
Yeah.
And 30 into 40.
Got it.
Now in 70 into 60, it is 99% and 98%. 1% volume hit and 2% price hit.
Yeah.
And here it is 99% and 96%. 1% volume hit and 4% price hit. Okay. Then it is 97% and 98%. And then it is 97% and 96%.
Yeah.
You didn't got it.
I got it. It's all in the question.
99 is 70 and 97 is 30. 98 is 60 and 96 is 40% probability.
Yeah, got it.
If you want, you can calculate the compound probability. Now, compound is simply this.
Yeah, what is that?
In compound probability, I just multiplied 0.7 into 0.6.
Okay, right, okay.
But you can simply write the formula completely also.
Okay.
Okay.
Yeah.
Now, why I have put power 2 on every year? Because
No idea.
the question, if you read it, 70% probability that after 2008 sale volume will decline by 1% per annum.
Also, it's to the power 2.
And the forecast we are making is for 20Y0.
Yeah.
You missed it.
I think your microphone is messed up.
There is 70% chance.
I heard that. Yeah, in years ending 30th September, June.
After June 2008, it will fall by 1% per annum.
Yeah.
And if I talk till 20Y0, so it will be 1% twice.
Yeah, got it.
That is why I'm putting power 2 on everything.
Yeah.
So this is my forecasted revenue, 427 million. You didn't got it.
No, I got it, sir. I got it.
Then if I talk about the wheat cost.
Why have you... Okay, X7, X8. Everything was same for X7, X8.
Yes. The basic aim of doing is for 30th June Y0.
Yeah.
Okay.
So yeah, for wheat cost is 70% times 99%, 30% times 97%.
Selling price will not affect the wheat cost. Okay. So it will 74 million.
So it's the sales volume times volume options.
There are two probabilities in volume, that either it will be 99% or it will be 97%. You're not getting it, I think. Can you hear me?
Yeah.
What do you want to ask?
So why is it 70% times 99% now?
Because it is written here that there is a 70% probability that volume will decline by 1% and 30% probability that it will decline by 3%.
So 70 times 1 times 99% and 30% times 97%.
Okay.
Yeah.
So basically what is happening is that 70% into 99%.
Do you just do that times to the power 2?
Sorry. Yes. Power 2 into 76960, your existing cost. So you will get this amount.
Existing cost. Why are we timesing it by existing?
Because my friend, if you just multiply 0.7 into 0.99 power 2.
So is that what you've done with revenue as well? You have to times the revenue by 467,600.
Obviously. Because if you just multiply 0.7 into 0.99 into power 2, you will get this decimal.
Yeah, I know. But so then how have you done it over there? You've done...
Because your existing wheat cost will take a change by these percentages.
No. I'm asking how you do the calculation, sir. So for revenue, did you do everything one by one, then times it by 467,600 at the end, or every line by times by 467?
Right? 70 into 60 into 99 into 98 into power 2 multiplied by this revenue 467 600 000. Every line will do this.
Yeah. Okay. All right.
Okay.
All right. Got it. Okay. It's fine.
Do this 76960 000. 76960 000.
I got it.
And
Yeah.
variable cost, you will do this. 236,800,000.
Yeah. Yeah. Got it. Got it.
The fixed cost will not change. It will remain
Yeah.
at 120 million. So your forecasted profit will be then 4 million.
Yeah.
Now, if you look at this, if your operating profit becomes 4 million, and there is also a chance that you may lose the save low contract, so obviously you can say that things are going towards impairment as per IS 36. If you look at the financial reporting implication, because your existing profit levels, which are 33.8 million, will fall to the low levels of 4 million.
Yeah.
So
There's hint of impairment. You're saying.
for impairment, and you may also face some going concern issues also.
Yeah. Got it. Okay.
Are you getting it?
Yeah.
Okay. Now, if we develop some basic commentary, he asked us here that calculate the operating profit forecast. So we calculated it as 4 million. Now,
Mm.
implication of the forecast for business sustainability. So obviously, it is an alarming situation. Obviously, it is
To
alarming.
sustain.
In this forecast, we have assumed that there will be no change in the save low current terms. If I'll put the impact of current terms of save low, then things will get more drastic.
Yeah. Got it. Got it. Got it.
Forecast operating profit of 20Y0 creates a concern for triple B sustainability, as profits have drastically declined from 33 million to 4 million.
You know, all the thing we did, was that with the Savelo, everything? Was that including the Savelo contract?
We assume that there will be no change in the save low contract.
Mm. Okay.
Okay?
Yeah.
Because it was a working assumption that assumed that save low contract is on the current terms. If one
Okay.
expands a bit further, then triple B will suffer loss. The operating profit calculation has not considered the impact of save low contract. If that contract is cancelled or demands of save low are accepted, then triple B will suffer loss.
Yeah. Got it.
Low is demanding a decline in price per loaf by 0.02 from 0.75 to 0.73. This shows a decline of 2.6% from current profit levels.
Yeah.
Operating forecast consider that price decline will be 2% at 60% probability. If this decline is converted to 2.6% decline at 60% probability, then triple B will suffer a loss.
What is this talking about?
Your forecast was that there is 60% probability that price will fall by 2% and 40% probability that price will fall by 4%. If you accept the save low demands, your price will decline by 2.6%.
Where'd you get the 2.6% from?
Because save low is saying that reduce our price by 0.02 from 0.75 to 0.73. So this gives a 2.6% decline.
Okay. All right.
It is to note that save low has stated that required decline of 2.6 is not negotiable. Rather, it is a condition of working with triple B.
All right. Got it.
Further barriers to entry in triple B market are low, therefore new competitors may enter the market and force the selling price downward.
Mm.
Lastly, it needs to be evaluated that retail industry of baked bread is suffering competition due to which prices are declining. Volume may also fall further as people are moving from simple, unconventional bread to flavored breads. It was written in the question. So these all things create a concern on the sustainability of the triple B. And as far as financial reporting impact is concerned, you need to think about the going concern and you need to think about IS 36 impairment issues.
Got it. Okay.
Okay.
All
Going
right.
status issues and IS 36 impairment issues because the projection shows that your profits will take a significant hit.
Got it.
Okay.
Yeah. All right. That's fine. I'll read this. I'll do this myself. This bit.
Discussion of ethical issues because it was written that we have received the email of the production director who says that silently change the quality of the wheat we use. So
Yeah. That's
these are
fine.
the ethical issues. It creates concerns of integrity. And as we have received an unintended email, that email
Yeah.
was not meant to be received by us. So that is issue of confidentiality also.
So can you remove all the annotations, please?
Okay.